Good morning, everyone. Thank you so much for joining us today. I'm excited to introduce John McDonough, a subject matter expert who specializes in working with high net worth individuals and families. John is deeply experienced in advanced planning strategies and helps clients protect what they've built, improve tax efficiency, and make confident decisions around long-term wealth, income, and legacy planning. Today's conversation is designed specifically for those with more complex financial situations, where decisions carry greater impact and strategies require a high level of expertise. John will share practical insights drawn from real client scenarios, highlighting how thoughtful planning can reduce uncertainty, preserve wealth, and support long term goals. We're excited to have John with us. John, I'll pass the mic over to you.
Thank you so much. And if you're a successful business owner, founder, or investor, chances are you spent decades focused on one thing, and that's building value, revenue, growth, exit optionality. But here's what I've learned working with 8 and 9 figure families. Winning the business game doesn't automatically mean you win the wealth game because once liquidity hits, the rules change. And the opponent you're now playing against isn't the market, it's taxation. So the real question becomes, how much of what you've built do you want to actually get to keep? So for context, I work with founders, closely held business owners, and sophisticated families who already have success behind them. My role isn't product selection, it's outcome design. Last session, we talked about golden handcuffs, how companies retain top talent efficiently. And today, we're moving up a level. This is about how sophisticated families structure wealth after success. Once the exit happens, once the liquidity shows up, and once the headlines fade, because that's where most mistakes get made. And let me be very clear about what today is and what today is not. Not a pitch, not investment advice, not a recommendation. This is about structure. It's about understanding why certain tools exist and who they're actually designed for. These strategies require coordination, CPA, attorney, investment manager, and suitability is non negotiable. If someone shows you this and makes it sound easy, something isn't being ignored. To understand why these structures exist, we have to start with the real problem, and that's taxes. Liquidity events trigger multiple layers: capital gains, net investment income tax, and often ordinary income. But here's what most people miss: taxes don't just show up at the sale. After the sale, wealth usually moves into taxable portfolios. And from that point forward, taxes become a permanent drag on compounding. Taxes are the silent partner and they compound every single year. Most investors obsess over transaction tax, but sophisticated families obsess over the ongoing tax. Because even a 1 to 2% annual tax drag doesn't feel painful in any one year, but compound that over 10, 15, 20 years, it quietly destroys outcomes. Trust tax brackets compress fast. High turnover strategies are brutally inefficient in taxable accounts, and income heavy portfolios leak consistently. So if taxes reduce compounding every year, shouldn't tax strategy be part of the investment conversation? And the answer is obviously yes, it should. And here's the core shift in thinking: the investment isn't the issue, the container is. Same strategy, same manager, same return assumptions, completely different outcomes depending on how it's structured. Tax strategy isn't separate from investing, it is investing, just spoken in another language. And that brings us to private placement life insurance, PPLI, or private placement variable annuity, PPVA. These are not investments. They are insurance regulated containers that hold investments. Private placement life insurance is designed for advanced planning. It includes a death benefit, which allows for both tax efficient growth and estate transfer. Private placement variable annuities focus more on income deferral, less estate emphasis, more timing control. The wrapper doesn't change the strategy, it changes the tax framework. And these weren't created for the masses. They exist because sophisticated investors demanded better tax alignment, alignment between investment strategy, tax efficiency, estate planning, and governance. And they operate under strict rules, diversification requirements, investor control limitations, and ongoing compliance. This is not a loophole, it's a regulated structure. Post exit, entrepreneurs face three problems at one time: concentrated taxable wealth, tax inefficient strategies, and legacy planning decisions, which are often too late. PPLI and PPVA are often evaluated when someone says, I'm tired of writing checks, I don't have to write. And the question is, at what point does efficiency matter more than excitement for you? So this is asset location, not asset allocation right here. Accounts. Some absolutely do not. And these structures don't replace portfolios, they optimize them. It's not what you own, it's where you own it. And this slide right here is where most people finally get it. Because if you misunderstand this distinction, everything else sounds like hype. On the left, we have traditional retail life insurance. And this is what most people think of when they hear the words life insurance. Retail insurance is a boxed product, preset investments, street level pricing, preset custodians, and a fixed structure. In other words, you're choosing from what the carrier allows you to choose from. And to be clear, that doesn't make it bad, it makes it standardized. Retail insurance is designed to be broadly distributed, easy regulated, and appropriate for the general public. But let me ask you this. If you've built a highly customized business or investment strategy, does a one size fits all box usually feel best optimized for you? Now let's look at the right side. Private placement life insurance is not a boxed product. It's a custom built structure, institutional pricing, flexible custodians, customizable investment lineups, customizable policy design. You're not buying a product, you're engineering a solution. The insurance carrier provides the regulatory wrapper, the investment strategy sits inside of it. So who is this suitable for? This is also why PPLI is not offered to everyone. These are unregistered securities, available only to qualified purchasers and accredited investors. Higher minimums, higher complexity, higher responsibility. And this isn't about access, it's about appropriateness. So when people ask, is PPLI better than retail insurance? That's really the wrong question to ask. The real question is, what problem are you trying to solve? If the problem is protection and simplicity, then retail insurance works just fine. If the problem is tax drag, asset location, governance, and long-term compounding on a substantial capital platform, then private placement life insurance exists for that reason. And once you understand this difference, box versus tools, the next logical question becomes, what type of assets actually belong inside of a structure like this? So there are some non-negotiables here. We have 817 diversification, investor control rules, MEC awareness, modified endowment contract awareness, liquidity planning, and ongoing administration. And if governance isn't airtight, the structure fails. This is precision engineering, not retail insurance. So look at this case study. Same individual, same investment strategy, same assumed return. The difference wasn't performance, it was friction. So over 20 years, the structured outcome preserved materially more capital, not by taking more risk, but by leaking less. And three things have changed: reduced annual tax drag, improved compounding, and estate integration from day one. The benefit wasn't higher returns, it was keeping capital that would have otherwise been taxed away. So let's recap. Liquidity events create tax friction. Taxes compound annually. PPLI and PPVA are tax-aware containers, and success depends on structure and governance. If you've had or expect to have a liquidity event and you don't know how much annual tax drag your portfolio is carrying, well, maybe we should talk about that. Would it make sense to at least understand that number before making your next move? That's the next step: clarity. So I want to end a little bit differently. Instead of rapid fire answers, I want you to think about the questions themselves, because the quality of your outcome is usually tied to the quality of the questions you're asking. And these aren't technical questions, they're decision questions. So when does PPLI make sense versus PPVA? This isn't a which is better conversation. The real divider here is intent. PPLI tends to show up when someone cares about long-term compounding and estate efficiency, when the capital is meant to outlive them, or you hear, I'm never going to spend that money. PPVA often shows up when the priority is income timing and deferral and less about legacy. It's more about control. So the better question is, are you trying to optimize for income during your lifetime or outcomes beyond your lifetime? Second question, how do these work with trusts and estate planning? These structures don't replace estate planning. They plug into estate planning. Trust ownership, beneficiary design, liquidity planning, all of that has to be coordinated intentionally. When done correctly, the insurance structure becomes a delivery mechanism inside the estate plan, not an afterthought. If your investment strategy and estate plan live in separate silos, that's usually where inefficiency begins to creep in. Third question, what are the biggest mistakes people make? The biggest mistake isn't choosing the wrong structure. It's choosing a structure before understanding the actual problem. And I see three common issues. One, treating this like an investment instead of a framework. Two, ignoring governance and compliance. And three, forcing complexity where it isn't warranted. Just because something isn't sophisticated doesn't mean it's suitable. And the fourth question, how do you evaluate cost versus benefit responsibility? This is the most important question on the slide. Cost should never be evaluated in isolation. The right comparison isn't cost versus return, it's cost versus tax drag avoided. If you're not quantifying the annual tax friction your portfolio is experiencing, you're simply guessing, not analyzing. So the responsible question becomes, what is the structure replacing and what is it preventing? If you notice, none of these questions start with what product should I buy? They start with clarity, clarity around objectives, clarity around friction, clarity around coordination. And when clarity becomes first, the right structure usually reveals itself. And if today raised questions for you, especially around tax drag and post liquidity planning, that's not a problem. That's awareness. And awareness is always the first step to better outcomes. If you have any questions, do not hesitate to reach out to us. Thank you.